Awesome. Hi, I'm going to start over. I'm Sarah Dash. I am President and CEO of the Alliance for Health Reform, and I'd like to welcome all of you to today's briefing. This briefing is part of a series on the future of health insurance, and we will actually be doing three summits on the future of health care this year, starting with the future of health insurance, moving on to the future of chronic care, and then the future of the healthcare workforce. So we're really excited that you're here, and it's certainly I think fair to say that when it comes to health insurance, the future starts here and now in the Senate. We have a lot to talk about today, but before we do, I want to thank our sponsors for today's session. Our annual Summit Series sponsors are Anthem, Ascension, and Health is Primary. And I would like to thank them. Also, the Blue Cross Blue Shield Association, CVS Health, and our other sponsors for their generous support. And I would also like to just point out one of our board members who's here with us today. One of our new board members is Meg Murray from the Association of Community Affiliated Plans. So thanks for being here. We're going to hear a couple of brief words from two of our annual series sponsors. First, I would like to introduce Sean Martin. He is Senior Vice President for Advocacy, Practice Advancement, and Policy at the American Academy of Family Physicians, here to say a few words on behalf of Health is Primary. Sean.
Thank you very much, and congratulations on securing the Friday after a health reform vote for this discussion. That was excellent leadership. Good morning, my name is Sean Martin. I'm with the American Academy of Family Physicians, but I'm actually here on behalf of Health is Primary. About 3 years ago, the Academy and 7 other family medicine organizations launched a campaign called Health is Primary to draw attention to the value of primary and preventive care in our healthcare system. There's a lot of debate taking place in Washington, D.C. right now, clearly. But one thing that we know is that investments in primary care and prevention actually pay long-term dividends. And I would point out a recent study that was done in the state of Oregon by Portland State University that found in that state for every dollar invested in primary and preventive care produced $13 in upstream savings to the healthcare systems in the state of Oregon. The Health of Primary campaign is pleased to sponsor this event here today. Congratulations on your timing again, and we look forward to a really good discussion.
Great, thanks, Sean. And now I'd like to introduce Mark Hayes. Mark is Senior Vice President of Federal Policy and Advocacy at Ascension for a few words.
Good morning, everyone. We are very glad to be a sponsor of this session, very timely today. If you don't know about us already, Ascension is the largest nonprofit health system in the United States and the largest Catholic system in the world. We are committed to achieving 100% access and 100% coverage. And this session is so timely as all eyes move to the Senate to work the very hard work to strengthen and stabilize the individual market, in particular, ensure that health plans can participate and have a vibrant, competitive market where there's affordable access to coverage, and also to preserve the coverage that we have under current law. So we are looking forward to this session today. We thank you all for being here, and thank you all for being here very much. So have at it.
Thank you, Mark. Great, so now we get to the substance, and let me just set a little bit of context for today's conversation. Clearly in the wake of the House passage of the Affordable Health Care Act yesterday, there are a lot of questions about what happens next, and there are going to be a lot of questions certainly about the politics and the process, and we're going to leave those questions to others. We're really going to focus on the policy and the policy details, because as this conversation moves to the Senate and beyond, this is going to be, the policy details are, of course, going to be critically important. Secondly, we're going to focus today on the individual health insurance market, because there are immediate questions about what happens next in this marketplace. We know that health insurers today, this week, this month, are making decisions about whether to participate in the market in 2018. They're looking to 2019 and beyond, and there are potentially significant impacts on patients, on families, on the health system as a whole, and on the market. So we have a fantastic panel today, and without further ado, I'm going to introduce them. Karen Pollitz to my left is a senior fellow at the Kaiser Family Foundation, where she works on the program for the study of health reform and private health insurance, and she tracks implementation of health reform with a focus on the consumer protections in the system. Next, Deep Banerjee is a director with S&P Global Financial Services Ratings Group. Which covers a portfolio of publicly traded and private insurance companies, and he will tell us more about the market impacts. Next, Cori Uccello is an actuary and senior health fellow at the American Academy of Actuaries, and they provide nonpartisan technical assistance to federal and state policymakers and regulators. Finally, and certainly last but not least, Brian Webb is Assistant Director for Health Policy and Legislation for the National Association of Insurance Commissioners, which represents insurance regulators in all 50 states, the District of Columbia, and 5 U.S. territories. So without further ado, we're going to turn it over to Karen for an overview, and let's go. Thank you, Karen.
Thanks, Sarah, and hi, everyone. I would echo the remarks that this has to be the most timely Alliance event that I've ever participated in, and probably the most aptly named. The individual health insurance market is indeed at a crossroads, and the signs are not yet clear where it's going next. So my job today is to remind you where this market has been, and the change in direction it took to get where it is today, and then tee up discussion with my esteemed colleagues on the panel about issues, raising questions about where it could go in the future. Just as a reminder, the individual market, this is the smallest part of our health coverage system. Only about 8% of non-elderly people get their coverage through the individual market today. Most of us are covered either at work in job-based plans or through public programs, mostly Medicaid, CHIP, and then Medicare for some disabled under 65. The individual market is largely a transitional market and a residual market. It's where people go when they don't qualify for these other sources of coverage. So a lot of people kind of move through this market. They may be here for a year or two while they're between jobs, or while they're working in a job that doesn't offer health benefits, or while they are just coming off or getting ready to go on a public program. About a third of people in this market live here all the time. That would be the self-employed and small business owners who don't sponsor a group health plan. So that's about a third of the market, give or take. Those are people who really, this is where they get their coverage, and they don't really belong in any of the other places. So it's a small market, but it's kind of the tail that wags the dog in our health coverage system. In over a 3-year period, as many as 1 in 4 adults needs to get coverage in this market, at least temporarily. And before the market reforms in 2014, it was often very hard to do this. But since new market rules and subsidies, the market enrollment in this market has grown. It's right in the neighborhood of 20 million people now. About 2/3 of them buy their coverage through the marketplaces set up under the Affordable Care Act. About 20% are buying ACA-compliant plans that follow the new market rules off marketplace, either because they're not eligible for subsidies or they don't know that they're eligible for subsidies. And then we estimate about 12% are enrolled in non-compliant plans in the individual market. These are the grandfathered plans that didn't have to conform, and the so-called grandmothered plans, the transitional plans that people had just as the market reforms came in place in 2014, and they were allowed to keep them temporarily. It is fair to say that this market was entirely transformed by the ACA. Before 2014, this was a voluntary market. Now we have an individual mandate. There's a requirement to buy coverage, and if you don't qualify in those other places, you're supposed to come here to get it. Before 2014, this was mostly an unsubsidized market. There were a few tax credits for the self-employed, but basically people paid 100% of the premium with their own after-tax dollars. Now it's a heavily subsidized market, at least if you qualify for subsidies in the marketplace. Premium subsidies up to 4 times the poverty level. Also help with cost sharing, your deductibles and copays up to incomes of 2.5 times the poverty level. Those two features before the marketplace, the fact that it was voluntary and unsubsidized, meant that insurers were exceedingly nervous about adverse selection. They were worried that in order to part with those, high dollars to buy premiums, that people would make decisions based on whether they expected to need to use their health insurance in the coming year, and that they were more inclined to sit out if they didn't. Insurers always worry about adverse selection. There's kind of a rule of thumb about human beings that 20% of us in any given year account for 80% of all healthcare spending. So we're mostly healthy most of the time. But when we get sick or have a complicated pregnancy, then our claims can get really high. That's what insurance is supposed to do. It's supposed to pool risks, but it can't do that if people stay out when they're healthy and only want to buy coverage when they're sick. Before the ACA, as a result, the individual market was medically underwritten. People would, at application, would be turned down or charged more or have their pre-existing condition excluded. So your ability to buy coverage and to buy affordable coverage was entirely dependent on your health status. Now, of course, that's not allowed under the ACA. In return for making this market mandatory and subsidizing it, insurers are required to take everybody and charge them basically the same rate. This market, benefits were highly variable in this market. In particular, it was unusual to see policies that covered maternity care unless state law required it. We often saw limits or the absence of coverage for other benefits like mental health, substance abuse treatment, rehab, prescription drugs. The definition of health insurance under federal law before the ACA was anything a health insurance company sells. With the ACA, essential health benefit standards were added and also limits on cost sharing. So those were done to kind of make coverage meaningful, but also just definitional. If we're going to require that people have something and we're going to subsidize it, we want to know what it is. So now, health insurance in the individual market has to be major medical coverage. It was inefficient before. Loss ratios were low. That's the amount of premium dollar that insurers spend on benefits. They were writing 60, 70% before the individual market. Now they have to be at least 80%, or else insurers have to give people a rebate the following year. They haven't had any trouble hitting that 80% MLR. I'll talk about that in a minute. And so this market, I think, has been entirely transformed. And that transition was difficult, I think, challenging anyway for insurance companies. They really had to adopt an entirely new business model. And when the new individual market and marketplaces opened in 2014, insurers were offering products that they hadn't necessarily offered before. They were selling them to a public that they weren't used to covering. They had new competition by plans that they hadn't competed with before. Actuaries, Cori will tell you, they like to do their estimates based on experience, and they just didn't have any experience with this new market. So we saw a lot of volatility in pricing in the early years, and a lot of insurers really underpriced their policies in the first year in particular. The premiums came in way lower than anybody expected. Sometimes that was just kind of a calculation error. Other carriers, I think, were pricing very aggressively, hoping to kind of, tie up new market share early on. So insurers have had to get used to that, and that has been tricky. There were other things during the implementation. It is fair to say that the early years of implementation did not run like clockwork. So lots of things didn't work out as expected. There were risk stabilization programs. I'll let my colleagues talk about those a little bit more, but they were meant to kind of cushion these mistakes in estimating and cushion losses in the marketplace. They didn't operate the way that folks expected. There was, I think, ongoing concern, and still is the mandate strong enough, and are the subsidies high enough to kind of cure this adverse selection? About, 70% or more of people who are uninsured claim an exemption from the mandate because coverage isn't affordable. The subsidies are on a sliding scale up to 4 times the poverty level, but at 2.5 times they kind of run out. So that's been an issue. Then, the website didn't work in 2014. There were a lot of things. And then there were also things, I think, unique in individual market areas that that fueled the volatility and made it harder for insurers to work. This is a map that you've probably seen on our website that just shows the number of insurance companies participating in the marketplace by county in the United States. The orange areas are areas where there is just one insurance company selling. The blue areas are 2, and the gray areas, there are 3 or more insurance companies competing in the marketplace. Lots of reasons why the orange areas are the way they are, but 2 in particular, when you look at the all orange states, Wyoming and Arizona and Alaska and so forth, Alabama, those are all states, number one, that have high concentration of rural areas. And so low population. It's hard for multiple insurance companies to compete when there aren't very many people buying in the first place. And there are also areas in states that did not elect the Medicaid expansion. It turns out, and one of our papers in your packet talks about risk scores of market participants by states. The health status, it tends to be lower and the risk score higher in areas that haven't expanded Medicaid. Poverty turns out to be correlated with health problems, and there's also a lot of enrollment volatility at low income levels as income changes, and so eligibility for subsidies change. So that's sort of a common theme, but there are also other areas where there's stuff going on. Tennessee, which is almost all orange, for example, has sort of an interesting thing going on that works against stability in the marketplace. There's an organization called the Farm Bureau, which is not a licensed health insurer, and so it doesn't have to follow the market rules, but they sell health coverage. So they basically get to cherry pick the other insurers in the marketplace. And then Iowa, which mostly now is gray and blue, but that may go orange or will need a new color for 0. Is a state that has a very high concentration of non-compliant plans. About half of the people in the individual market in Iowa are in these grandfathered or grandmothered plans. So insurers that are selling in that market are kind of cannibalizing their own risk pool, and that leads to problems as well. But elsewhere, you do see a lot of insurer participation. And about 57% of people who participate in the marketplace are in an area where there are 3 or more companies participating. And I think that's a sign that, at least in a lot of areas, the marketplace is stabilizing. Actually, I should point out, this is what the market looks like today, but this all reflects insurer decisions made last summer. Okay, before the election, before all the stuff that we're doing now. This was just sort of based on how are they doing with all this other kind of problems going on with implementation. But I think insurers are kind of getting the hang of it. Their MLR data shows that their margins are coming back up. And that we probably aren't in a death spiral. I'm going to let our panelists talk about that some more. So that leads us to where we are now. Since the election, there's a new kind of political X factor that is causing a lot of uncertainty in the marketplace. In particular, insurers are really worried about whether these cost-sharing subsidies are going to continue to be paid. If not, they're on the hook for providing the subsidies, but they don't get reimbursed by the government. These cost between $7 and $10 billion a year, and insurers have said, one has said they will leave the marketplace altogether if these payments stop or aren't guaranteed for 2018. Other insurers now, I think, are filing kind of 2 sets of rates for 2018, one if these payments get made and one if they don't, but also talking about leaving the marketplace altogether. The individual mandate is still kind of a question mark. The first executive order by the president on health care was, let's look for ways to not enforce any kind of burdens on people or companies. The secretary has broad authority to grant exemptions, just hardship exemptions, to the individual mandate. So there's some concern about what will happen there. Absent the mandate, with keeping everything else in place, CBO has said that alone will cause premiums to go up 15–20%. And then just kind of the future of outreach. How will the next open enrollment work? The new administration also came in and canceled the final week of kind of outreach activities during open enrollment 4. They've since announced that the next open enrollment is going to be half as long as we thought it was going to be, so that raises just questions about how active will the outreach be, given that, you know, Obamacare is horrible and a mess, and, you know, is that going to be kind of an effective selling job to get people to sign up for 2014? And then, of course, we've got what's going on in the Hill. The House bill passed yesterday. Makes a lot of changes to the marketplace, and I think it raises real questions about how it could operate going forward, and how or whether insurers will want to participate. The House bill does make this a mandatory market again, repeals the individual mandate, actually retroactive to last year. It keeps in place the market rules and the essential health benefits, but it reduces the subsidies substantially. And then it keeps in place the Medicaid expansion, but substantially reduces federal matching money for that population and, in fact, the entire Medicaid program. So this kind of adverse selection factor is back again, and I think insurers are worried about that. Changes were added to the bill over the course of amendments to try to offset that, including flexibility for states to elect to waive the essential health benefits, and also to waive community rating, to actually ease up on one of those market rules so that insurers would have the ability to screen out of the pool some of the most expensive people. And then in addition, this fund for states, the $100 billion fund that is available for a lot of purposes to offset some of the other changes in the bill. States could use that for the cost-sharing subsidies to replace some or all of those that were repealed. They could use it for reinsurance, which worked pretty well in the first year of the ACA. They could use it for high-risk pools, for a lot of different purposes. So we don't know yet if this is going to be enacted or a different version of this, but I think it's pretty clear if something does get enacted, insurers are going to have to start over again, new learning curve, figuring out how to compete in a new market under these new provisions, and what that will mean for the cost of coverage and who can participate and what will happen to people when they're sick. I guess we will find out. So I'm going to leave it there. Thanks.
Thank you so much. Deep.
Hi, good afternoon. Hey, good afternoon. Yesterday when I was leaving home to fly to DC, my wife said, "Be careful." And that's when I realized she's been watching C-SPAN all day. So if you're still watching, I'm fine, honey. So I'm going to continue a little bit what Karen talked about, focus on the individual market in its current form, how it is, and perhaps with questions we can talk about a little bit about the longer future. But we also have a near-term forecast, which is more immediate, and we'll talk about that a little bit. If you see me leaning in, there's a giant clock with my time on it, so that's why I'm leaning in sometimes. All right, so similar to Karen's thoughts, 2014, the way we think about it is year one. Obviously, ACA was passed in 2010, but more of the things that we consider to be part of the individual market today came into effect in 2014, including the exchanges. So we consider that to be year one. Year one was pretty bad for insurers. Excluding just a few handful, everybody made losses that year in the individual segment of their business. 2015 actually got worse, and that was a little alarming. We expected maybe an improvement, but it wasn't. There was a good reason for it, though, because insurance companies put in their price well in advance of the year they're supposed to market their products. So although they had a feeling that 2014 probably wasn't going as well as expected, they just didn't have enough time to make the corrections they needed to. So 2015 got worse. Also, another big thing that happened in 2015 was the news that one of the 3 Rs, there are 3 Rs that were set up in the ACA that were considered to be premium stabilization forces. One of them, the risk corridor, wasn't going to be funded. And they found that out after the fact, and that also didn't help. But then came 2016, and we focused on that quite a bit, because the question was, if 16, where they had a little more time to correct, to make some changes to pricing and product, if 16 was actually worse, then perhaps this wasn't a manageable market. Now, the data shows that 16 was actually better than 15. What you're seeing on this slide is what is commonly referred to as medical loss ratios, or MLRs. Now, MLRs are part of ACA, part of the law, but well before ACA, MLRs is a number or a ratio we used to look at as analysts to understand how a company is doing. So if you look at the individual market MLR, 2014 was 97.5%. Now, what does that mean? That means for every dollar in premiums that came in the door, they had to pay out 97 cents or 98 cents as claims. So that went out the door. 2015 was worse, 102.3%. That means they actually paid out more than $1 of premiums that came in the door. And then 2016 shows kind of a marked improvement. The reason we put in the group market MLRs next to it is to give you a benchmark. If you see, the group market MLRs are far better, but more importantly, far stable, which goes to the point that the individual market today isn't as stable as as the insurance companies probably would like it to be. It may not come to the same level of profitability as the group market, but probably could come to some amount of stability in the future. This slide is showing gross margins. It's simply another metric we look at. It's kind of if you take the MLR and turn it on its head, you get gross margins. Similar thing that I talked about before. If you see 2015 was worse, you have a negative 2% margin, and 2016 gets better. The one thing I want to point out here is gross margin is before any administrative costs that the insurance companies have. So this is purely premiums minus medical claims. So if you tack on to these numbers, admin cost, you will realize that the insurance companies made, on average, an underwriting loss for all these years, actually. Now, compared that to the group market, the gross margins are obviously much higher. So even if you tack on the admin cost, they would still have made a profit. So let's talk about the future a little bit. So I'm going to talk about two kinds of forecasts. One is business as usual. What we mean by that is everything stays with obviously some changes, but no big overhaul to the rules of the marketplace. If that's the case, what do we expect? Well, we expect 2017 to be a year when more insurance companies get to break-even margin. So break-even, 0%, so no loss, break-even margin. And then continued improvement in 2018, where they get to small single-digit margins in this line of business. It is still a very fragile market, and it needs time to stabilize. But probably the more important discussion is business unusual or business interrupted forecast. So there is obviously a lot of pricing and insurer participation issues in the marketplace today going into 2018. One of the biggest things that we look at is the CSR, which there is some uncertainty about the future funding of that. The reason the CSR is important, it's not because just the dollar amount that goes towards it, but more importantly, it is paid to the insurance companies after the fact. So the insurance company on day one accepts members who are CSR eligible and start paying out claims based on the fact that they'll receive a CSR. They only receive the federal government funding for the CSR later on. So insurance companies don't want to be in a situation where they find out 6 months into the year, hey, guess what? You don't get that money anymore. So what we expect to happen are two options available to insurance companies. One, they would price with what we are calling an uncertainty buffer. So let's say they were expecting to price high single-digit premium increases for next year. They would probably tack on a little bit of this uncertainty buffer because they don't know what's going to happen. They can load the silver plan with the CSR that they're not going to get. So you'll see the silver plan premiums go up. The second option, which is probably a little more drastic, is they get more selective about participating. If there is greater amount of uncertainty, they could decide to pull out of certain counties or certain states. And the third one, which is probably important to mention too, that the marketplace has a set of rules. It's kind of, change. If the rules are changed after you're already playing the game, it becomes harder to adjust. So rules like the individual mandate or the special enrollment periods, enforcement of that will also be critical for the future stabilization of the marketplace. And perhaps we'll talk about AHCA later on when questions come up. Thank you, Sarah.
Great, thank you so much, Deep, and let me turn it over to Cori Uccello. Thanks.
That's not right. First, I'd like to thank Sarah and the Alliance for inviting me to participate today. As others have already pointed out, we're in a different situation today than maybe we were a couple days ago, but I'm going to still focus my remarks at a fairly general level and discuss the kinds of actions that are needed to improve the stability and sustainability of the individual market. Before getting to those potential improvements, I think it's important for us to know what the goals are. So first, I'll talk about what's necessary in order to have a stable and sustainable market. First, we need enrollment levels that are high enough to reduce random fluctuations and a balanced risk pool. In other words, we need enough healthy people so we can spread the costs of the high-cost people over a broader pool. Second, we need a stable regulatory environment that facilitates fair competition. And that includes not only a level playing field, but also consistent rules that are known in advance. Third, we need enough insurers participating to have insurer competition and consumer choice. And as Karen mentioned, the optimal number of insurers probably varies by area. And last but not least, because most premiums go toward paying medical claims, it's important not to overlook the need for continuing to control healthcare spending and improve quality of care. So how is the market doing compared to these criteria? Well, the ACA dramatically reduced uninsured rates, and participation and enrollment in the individual market increased. Nevertheless, in general, enrollment in the individual market was lower than initially expected, and the risk pool was less healthy than expected. Now, in the market, competing rules do generally face the same rules, so there's pretty much a level playing field. But the uncertain and changing legislative and regulatory environment have contributed to adverse experience among insurers. So this has led to a decrease in the number of participating insurers both in 2016 and 2017, and there's an indication there will be a further reduction of insurers in 2018. Continued uncertainty could lead to more insurer withdrawals, leaving consumers with fewer plan choices or potentially none at all. And as Deep has alluded to, insurer experience has stabilized, but the market itself is still fragile. So this leads me to the actions that should be taken to improve the market. I feel like I'm piling on here, but first and foremost is the need to fund the cost-sharing reductions. Not paying for these reductions or even uncertainty about whether they will be funded could lead to higher premiums. As Karen said, the Kaiser Family Foundation has estimated that on average, not paying for those CSRs could result in premium increases of nearly 20%. And that's on top of the premium increases that will already occur due to medical inflation and other factors. Second, the individual mandate needs to be enforced. The mandate is intended to increase enrollment and encourage even healthy people to enroll. And that's what's needed for a balanced risk pool. As Karen mentioned, the mandate itself is already fairly weak because the financial penalty is low, many people are exempt from the penalty, and enforcement itself is weak. But further weakening it would make it less effective and would lead to higher premiums. Strengthening it could improve the risk profile and put downward pressure on premiums. But enforcement itself isn't enough. I think there's a lot of people out there who don't even realize the mandate is still in play. And so it also needs to be publicized in order to be effective. Alternatives to the mandate are being explored, such as the continuous coverage requirements that were in the House passed bill. But it's difficult to structure those kinds of mechanisms so that they encourage healthy people to enroll sooner rather than later, while still providing protections to people with pre-existing conditions. So if the mandate is the stick to encourage enrollment, premium subsidies are the carrots. More external funding in the form of higher premium subsidies, or funding that will offset the cost of high-cost enrollees, such as through high-risk pools or these invisible high-risk pools or reinsurance, could help improve the pool. It's important to know that there are many, we use the word high-risk pools a lot, but there are actually several different ways that high-risk pools can be structured. In your packets, there is a paper from the Academy that talks about the different ways that that could be done. Like I said, they could be done in terms of the traditional high-risk pools that were in place prior to the ACA. They could be invisible risk pools so that the person enrolling in the private market stays in that plan, but their claims are paid through this external funding, and that could be, their eligibility for those risk pools could be based on either having certain conditions or having spending that exceeds a particular threshold. And finally, it's important to not only take actions to improve the market, but also avoid actions that could make things worse. So for instance, allowing the sales of insurance across state lines or expanding the availability of association health plans could actually lead to market fragmentation and higher premiums. So with that, I'll turn things over to Brian.
Well, thank you very much. I agree with all of them. It's always good to go last. I don't have to speak quite as much. But what I want to focus on today is just, we talk so much when we're out here in Washington, D.C., very broadly, very nationally, and we hear things like it's collapsing everywhere, everything's terrible, everybody's going to lose their insurance, or people say, hey, everything's fine, no problems, don't change a thing. The reality is it depends on where you're at. There are some areas in the country, in some states, where it's collapsing. There are many areas where things are going pretty good, little small changes will be fine. That's why I strongly encourage everybody here, as you consider kind of how we move forward, talk to your state regulator. Find out what actually is going on in your state. Where are the carriers? What are the prices? What are the issues going on in your state? And work with them to try to figure out how can you solve it for your state. Because the reality is you look at one state, you see one state. Every one of them is different, their markets are different, the regulatory environment is different, provision of care is different, demographics is different, it goes right down the line. And you just really have to work at a state level to figure out then how can the federal government promote better state solutions to solve a lot of these problems. So as you kind of talk to your state regulators, you should ask them, are carriers pulling out of the exchanges? Or, as we've seen in some states, are they pulling out of the individual market altogether, inside and outside? Is that just in some areas? How do we address that in certain areas? Or is it the whole state? And why? Why is this happening? And what can be done to solve it? Are there fewer options on the exchange? Meaning just HMOs, just narrow network HMOs? Or are there broader, more better options available? And again, if it's just very narrow networks, only HMOs, how can we solve that problem? Where are the premiums? Are they stabilizing, as they are in some areas, or are they very volatile and likely to see, again, major increases in 2018? Are commissions being eliminated? This is something that we're seeing in a lot of states where the carriers are not paying any commissions in the individual market. Some just on the exchange, some inside and outside. Now, why is that a big deal? Well, health insurance can be complicated for people. I always liken it to if I'm just filing a 1040EZ, I have a very little income, I can probably do that by myself. But if I got a lot of issues and a lot of investments and things like that, then I better talk to somebody who knows what they're doing. Same on health. I mean, if I'm not expected to really use a lot of health, okay, I can just go pick a plan. But if I have health needs, prescription drugs, things like that, you really should talk to an agent. And if they're not getting compensated, that could be a problem. Lower uninsured rates. Where is the uninsured rate in your state? Just about everywhere it's gone down, which is a good thing. People with pre-existing conditions, things like that, are getting coverage. But can we continue to make better inroads there? How do we get the rest of the people insured and in the marketplace? And then access for vulnerable populations. Again, that's a good thing. How do we make sure that continues even if there are changes? So talk to your state. What's going on? Now, as we look at just insurance in general and what has been going on over the last few years, it comes down to the biggest problem we have right now is uncertainty. Insurance, I think everybody at this table will agree, insurance hates uncertainty. You will pull out of a market, you will do that if there's uncertainty. And right now, there's still a tremendous amount of uncertainty. So the question for us is, as now the Senate moves on its efforts, how can they bring more certainty into this marketplace? We've seen unsustainable cost growth. Can we address that? Maybe not easily, but can we start addressing that in the long term? Unstable risk pool. How do we get the younger, healthier people into the marketplace and not just waiting until they get sick? How can we stabilize this marketplace? Or can we use reinsurance or high-risk pool, invisible otherwise, to try to stabilize a risk pool that's relatively unhealthy? Unreliable funding. Everybody has said it. I'm going to say it. CSRs, cost sharing reduction payments, must be assured for 2018, 2019, or we're just going to see a system that's going to continue to deteriorate. This also goes for any kind of other funding. Anything else you come up with, do not just say, hey, every year we may or may not appropriate this. That is not a good, reliable funding source. Think about that as you're thinking about this, because remember, carriers are figuring out their rates, figuring out whether they participate well before any appropriations or any kind of other decisions are being made at the federal government. They need to know the answer. And then the uncertain regulatory environment. States and federal government have to work together better. We're working on that. We're working with the Trump administration. You've seen the market stabilization regulation. We expect other ones that we'll just keep working with them on. Maybe not full regulations, but just how can we better regulate so that carriers get a single answer that they know what the answer is going to be. We need to keep working on all these things. And again, talk to your insurance commissioner about that. What are they doing? What can be done at the federal level to make sure these underlying issues are addressed as we move forward? And then that leads us to what's next. You know what's next. Next is legislation. What's the Senate going to do and when? And I'll make the pitch right now. If this is going to go into hearings and months and months and months of discussions, can I strongly encourage you to take care of CSRs right away? And if you're going to do any kind of reinsurance or anything like that, high-risk pools or any kind of funding like that, do that right away. We need to move on those to stabilize 2018 as soon as possible. Regulations will work on waivers. States are working on waivers to see if they can get some of these issues, because, again, very much state-specific solutions we need to work on. And we're still watching lawsuits, not just lawsuits like House v. Price, which deals with CSRs, but some of the risk corridor lawsuits as well. Where do those go? Can that bring some funding back in? But really, it's that top one. That's happening now. Will carriers participate in 2018? They are making a decision when? Now. What areas of the state will they participate in? Will they be on the exchange or just off the exchange? Will they pull out of the individual market altogether? You've seen the news. You've seen Aetna make some high-level decisions. Anybody from Virginia? Anybody have Aetna? You see people like Molina, who's been an expanding insurance company, say, hey, if I don't have insurances on CSR, I may pull out of the thing altogether. Those decisions are being made now, and the rates and forms are being filed in May, June, mid-July. July 17th is the last day. So decisions have to be made by then, or else the companies are going to start building in what we call loads. And they're just adding more rate increases just to kind of hedge their bets if they stay in at all. So that's what we're facing. We're facing a timing issue. We're facing uncertainty, and none of that is good right now for what's going to happen in 2018, 2019. So we just encourage you, talk to your state regulators, figure out what's necessary for your state, and let's get moving as quick as we can to try to resolve some of these issues. Call me anytime.
Great. Thank you all for your presentation. So I'm going to kick it off with a few questions for the panel, and then we'll open it up to audience Q&A. So let's start with this issue of uncertainty, because it's something all of you have mentioned, and all of you have mentioned, in some form or another. Brian, you just used the word a load. Deep, you used the term uncertainty buffer. Cori, you just, I think, said it most plainly that, it just means premiums will go up, right? Like with uncertainty, and that's that actuaries will price for uncertainty. So let me kick it off with kind of a little bit of a maybe provocative question. So, I mean, we knew, like on the CSRs, we knew that this lawsuit was in effect, the House v. Price previously, House v. Burwell. Are we in a situation where, insurers, what would have happened if they had priced for that uncertainty back then? I mean, how much can we expect actuaries, insurers to price for this kind of future uncertainty? And, I don't know if any of you want to kick that off and then maybe tie that into, if there is then continuing uncertainty as to whether high-risk pools will be funded or not, or what a stabilization fund will look like. Obviously, those things subject to appropriation. People on the CSRs have raised serious constitutional questions. How does that all play out?
I can start off, Sarah. So here are some numbers. So if you look at the 2017 premium hike that went into the marketplace, it was pretty significant. On average, it was somewhere between 20 to 25%. We looked at that and we considered that to be a correction, not something that would continue forever, every year, but more of a pricing correction that was needed to be made because premiums were lower than the risk in the marketplace. However, and so we expected for 2018, if you look forward, yes, premiums go up every year. That's kind of almost a fact of insurance because cost goes up every year. Inflation cost goes up every year. So, but we expected premium increases to be high single digit to low teens. Kind of that would be where the premiums would go up. So well below what it went up in 2017. However, if the CSR uncertainty is not resolved and and insurance companies want to participate and add in a buffer or a load, that number could again take us back to the rates we have seen in 2017. So you're looking at 20% or higher rate increases again. So obviously pretty significant. Now, what happens when premiums go up? That's also a critical question. For someone who receives a subsidy, we have seen that in 17, because how the subsidies work today in the ACA, the impact is almost negligible because the subsidy, based on your income obviously, is linked to the actual price of the plan, the second cheapest silver plan. So if the second cheapest silver plan goes up 20%, your subsidies should align with that as well. So the brunt won't be felt by on-exchange subsidized enrollees. However, it will be felt by the off-exchange non-subsidized enrollees. They have to pretty much pay sticker price. They don't get a discount. So we would expect that the marketplace would probably not decline significantly because of a premium hike in 18, but the off-exchange market would probably decline because as an impact of 2 years of continuous 20% plus premium hikes.
I would just add that whether and how an insurer can incorporate this uncertainty into their 2018 premiums somewhat depends on the state regulation. I mean, some states are requiring insurers to submit 2 sets of rates, so one assuming the CSRs are paid and one not, but others are requiring only rates that assume that they will be paid. And I think if we talk about adding in this buffer, I think it's pretty hard to add in a buffer of 20% when a risk margin is much, much lower than that. So I think that's a pretty difficult thing to do. So that's when you start, companies I think are starting to think, well, do we even want to participate at all?
And your regulators are talking to the carriers, trying to figure out if they're going to stay in. And this is one of the biggest issues that they raise. Pennsylvania was told by one carrier it'd be 15 to 20%. But then, of course, the regulator says, well, I don't know. And I don't know if I'm going to be able to allow that or justify that just because it's a I don't know. Your rates have to be according to what you actually will have or expect to have. So there are a couple of states, just a couple, that are getting 2 sets of rates. Most states are saying, just give it to me, assuming CSRs are going to be paid. But if it looks like that changes, we will have you resubmit those rates. Even after they've been submitted, we'll have you change them before we do any kind of final, which again is going to create more, what's the word? Uncertainty about what people are going to see the next year. And again, until they sign that dotted line and say, yes, I'm going to participate, which is, that's in September. We could not know all the way through the summer into early fall who's even in and out next year. And the more, more this isn't resolved, the more we won't know. So.
Thanks. And let me ask a question to sort of see if we can follow the breadcrumbs a little bit. So let's just play this out. So say premiums go up in any given scenario. If premiums go up, if you're subsidized deep, as you said, that under the current subsidy structure, that maybe doesn't affect you so much. Of course, it would affect the federal budget, right? If you're unsubsidized, how does that affordability factor play into adverse selection and the health of the market?
Yeah, I mean, for sure, the off exchange is where probably more of the risk is if premiums keep going up 20% or plus, because then someone buying that product who right now is paying sticker price and probably needs it, you're going to probably see that market shrink a little bit more, so it will be left with individuals who really need insurance, are not eligible for a subsidy and are paying for it. So the possibility of adverse selection does increase on the off-exchange market quite a bit if there's continuous double-digit or high double-digit premium increases going on.
And I think that's why the question about how strong is the mandate and how good are the subsidies, how adequate are the subsidies, it just becomes critical. So even for people who are subsidized, I think, who are protected from the rate increase, they still are required to pay at 2.5 times poverty. You're required to pay more than 8% of your household income for the premium. And then that doesn't take into account, you don't get any cost-sharing subsidies at that level. That doesn't take into account what you would have to pay in addition out of pocket every time you go to the doctor, because that hits your high deductible. So this adverse selection problem is not cured for sure. And the more people have to pay out of pocket for insurance, the tougher that decision is. If it's going to cost me, the average, I think, is about $300 a month for a young person, right? That's $300 a month for a young person. That's a car payment. So, are they really going to part with $300? Well, if they're thinking about maybe starting a family and having a baby, sure. And if they're not, and they think they're invisible, and they're not my kids because they know better, then then maybe they won't participate. And the tougher that financial trade-off decision that people make, the more insurers know adverse selection is going to be driving the decision.
So let me get to something. Karen, you alluded to like the structure of the subsidies under the current Affordable Care Act. So tied to a percentage of income and tied to the premium on the exchange. So the American Health Care Act would, of course, change the way that the subsidies are structured to more of a flat tax credit based on age. And so can anyone on the panel comment on what happens then? What is the impact if the structure of the subsidies, we could talk about levels, but this is a very different structure. So in terms of considerations going forward.
Yeah, sure. So the two things that are happening with AHCA that we took into account when we analyzed the impact on enrollment as well as insurance companies' earnings. One is the proposed structure is changing from linking the subsidy to the actual premium of the marketplace to being a flat amount that you get based on your age. Also, what's changing is the rate band, and this is critical. Right now, an insurance company can charge the oldest person in their pool 3 times the price of the youngest person. So we call it a 3:1 premium rate band. AHCA brings into effect or proposes a 5:1 rate band. So you can charge your oldest person 5 times the youngest person. If you take those two together, so there's a 5:1 rate band, and you remove the subsidy link to the actual cost of the marketplace price, then you will see, we expect that on the higher age groups, a decline in enrollment, because affordability will become a greater issue as you go older in your age group. It will actually may have some positives on the younger side, because 5:1 gives the insurance company flexibility to price a little lower for the younger population. And one thing that was noted earlier on this panel, that is an issue with today's marketplace. The mix isn't great in terms of morbidity, so perhaps that will help. But we expect a sharper decline on the older population, somewhat offset by the younger population, but net impact will be a decline in enrollment when you combine the way the tax credits will work in AHCA with the 5:1 rate band.
Just want to add something to that. I've said this in front of this group before, but I'm going to say it again, that it's important when we're talking about having a balanced risk pool that it's not just about young and old and getting young people into the pool. You want healthy people of all ages to participate. And if what Deep suggests would happen is as the older adults would face higher premiums, well, the people who are more willing to pay those premiums are going to be the ones who think they need a lot of health care. So you're going to get more adverse selection among that age group, and that could actually worsen the risk profile of that pool. So it's something else to keep in mind when it's not just about getting young folks into the pool and lowering average premiums that way. What we really need to have for a healthy, balanced risk pool is healthy people of all ages.
Sarah, if I can add just one thing real quick. The other point to be made is that, I think Karen talked about this also, although ACA or AHCA in the future is a federal law, insurance, and as Brian pointed out, is still very local. Every state is different. Even with ACA, which does a lot of standardization, if you go to every market, there are key differences in every market. One of the key differences is the average premium charged in every market is significantly different. So what ACA subsidy does is, because it's still linking you to your local premium price, you can be any state in the country but receive effectively the same benefit. What AHCA is proposing is a standard premium support no matter where you live. So if you're in a state where premiums are higher, the value of the subsidy is much lower to you than in a state where premiums are lower. So the disparity among states might also increase because of this construct.
That's very helpful, thank you. So that leads into my question, which I wanted to ask Brian, which is, we've heard a lot in the AHCA, but also in other legislation that's been proposed about giving the states more flexibility, giving them more options to, for example, waive community rating, to waive essential health benefits. Can you talk a little bit about how states are looking at that right now and at those choices, and what is the likely effect, if you can predict that? Thanks.
I cannot. But basically, what every state commissioner, along with their governor and the legislatures, they're all looking at their market and trying to figure out, how can I balance? Balance is the key. Yes, you want to protect consumers. You want to make sure they can get the coverage they need when they need it, and get to doctors and all of that. But you have to balance that with making something that's affordable. And we're also a marketplace where insurance companies actually want to participate. That's why it's so difficult, especially when a lot of them are kind of national standards kind of just put down. And that's where the flexibility we think is necessary, is to be able to take those national standards and say, okay, well, while that may work in that state or that area of my state, in this other area where it's more rural possibly, or because of the mix of demographics, or because of the structure of things, I need to be able to change things up a little bit so they can get actual carriers participating, and I can get affordable coverage to people. And that's a balance that's going to have to be made at the state level. And while that can create some concern about the impact on certain populations or things, it's something, if we're going to make it actually work, it's a discussion that has to be made. And since you are involving state legislators and governors and even some elected state regulators, the people will have a say in this. But we're just trying to work with the insurance carriers, the consumer groups, the stakeholders, the providers to try to figure, okay, this is the way it's working or not working now. How can we make it better? And that will require some tweaking at the state level.
See if anyone else on the panel wants to comment on that, and then we'll start to open it up to the audience for Q&A.
I think I agree with Brian. There's no way to know what states would do if they were given this new flexibility, but I think it's pretty likely that the insurance industry in most states would go to the Capitol and lobby for these waivers, certainly the community rating waivers. They've been clear all along. I remember sitting on a panel with Karen Ignani back in 2009 saying, you know, we'll do this guarantee issue community rating thing, but you have to have a strong mandate in there. We cannot do that in a voluntary market. We had experience in states that tried doing this in a voluntary market, New York, New Jersey, Vermont, before the ACA. And it's just really hard to offer stable, affordable premiums, even with some subsidy money on the table. It's just hard to do that in a voluntary market. So I think if they have to live in a voluntary market, they will go to their state capitals and say, you got to give us some relief on this rating thing. And we have experience with that as well. In the 90s, after the Clinton health reform thing didn't work, Congress enacted HIPAA, which did the privacy stuff that we all remember, but there was also a title that created portability rights into the individual market for some people who were leaving employer coverage. They lost their jobs or retired or whatever. And under the federal rule, under the federal law, those people could not be turned down. They couldn't have a pre-existing condition imposed, but there was no limit on what they could be charged. And the HIPAA premiums were really high because insurers said, you can't make us do this. You just can't make us do this. And waive underwriting for people because we know who's going to, you know, step up and who isn't. So the HIPAA premiums were often 3, 4, 5 times standard rates. In Denver, I think, there was a 2,000% of standard rate that was filed for HIPAA policies. So, it invites back, I think, the instability to have, you know, to have the rules kind of uneven in that way.
And just to follow up on that, so, you know, I mean, we've heard a lot about pre-existing conditions and what's really going to happen to people with pre-existing conditions if the rules under the ACA change. So, you know, can you walk us a little bit through, you just talked a little bit about essentially a continuity of coverage protection under HIPAA, but then the interplay with the premiums. So what did the ACA do, and then what happens under a potential change to that? And then while you're answering that, for folks who do have a question, there are mics on that side of the room and that side of the room. It's a little crowded, so I'll give you a little time to get over there. There are also green cards in your folders if you would like to write a question down and wave it. Someone will come and get it and hand it to me. Thanks. So pre-existing conditions.
So under the current law, people still do fall in and out of coverage, but in the months when they are uninsured, they owe a penalty unless they qualify for an exemption. And so the idea is, you know, the longer you wait to get back into coverage, the more months of penalty you have to pay. And we do, I didn't bring my numbers, but, you know, we do see millions of people every year owing that penalty when they file their tax return. We see millions more qualifying for an exemption, and that's because the subsidies are limited, and once you owe more than roughly 8% of income for the lowest cost plan, you can be exempt from the penalty. So the late enrollment penalties that we're talking about now, I think even CBO has said those are meant to kind of counter, right, the adverse selection, but they could kind of backfire because now you don't pay the penalty until you reattach to coverage. So if you're healthy this year and I don't, you know, I have to make my car payment, so I'm going to stay out, fine. And then next year, now I would owe even 30% more because of the late enrollment penalty, but I'm still feeling pretty good and I don't expect to have a baby, so I'm going to stay out another year. But if I do expect to have a baby, then I'll pay the 30% because I have to get back in, otherwise I have to pay for the delivery out of pocket. So the late enrollment penalty, the timing is off. And it actually rewards healthy people for staying uninsured longer. So that's why I think we then got to this amendment that said, well, okay, then what if we only penalize them when they sign up when they're sick? And that gets to sort of where we are in the MacArthur Amendment. And then that raises other issues about why is it that people experience a lapse in coverage? Are they just being irresponsible? Did they miss a payment? Did they lose a job and so they didn't have income? A lot of the things in life that dislodge coverage also change people's income. And they can't afford to just kind of pick back up and, resume coverage under some other way, or they just can't move that fast. So I think there are millions of people who experience a gap in coverage in any given year, and a lot of people who could then face this, these penalties when they go to sign back up again. And if they have pre-existing conditions, it could be really tough to get back in.
So I just want to make an observation about the allowing a waiver, states to have a waiver that would allow underwriting if people don't have continuous coverage and then later signed up. I think a potential implication of that is actually getting rid of community rating more broadly, even for people who had continuous coverage. Because what could happen is if healthy people who have continuous coverage, they could decide, well, wait a minute, I could go get underwritten and get a lower rate, potentially. So who do you have left in this continuously covered pool is just the not healthy people. Well, what's going to happen then? The premiums are going to go up to reflect the health status of that pool. So in effect then, unhealthy people are going to be paying high premiums regardless of whether they had continuous coverage. So that's just something to kind of keep in mind and why the details of these different kinds of provisions matter.
Just one kind of question on this. I mean, you talk pool. Do you read it as saying they can actually take those people and put them in a separate pool, or would they still be part of the single risk pool, which would be very different than HIPAA?
It's not clear.
Yeah, so clarity would be excellent. Because under HIPAA, it was a problem because basically they were saying most states just one single plan. That's the one you can buy, separate risk pool. Obviously, everybody in there is sick. The only reason they would do it, otherwise they just do COBRA for a while and then get out or whatever. But if they are still in the single risk pool, that would ameliorate at least some of those problems. Obviously, they can still rate, have to be actuarially sound way of rating based on health status. But at least they wouldn't be in an own sick pool.
And the complication is how do you run a risk adjustment program to transfer the money between those plans? I think it just becomes a lot more difficult.
So the details of these, the risk stabilization funding matters. So let me get to the mic, and then we have a couple questions on the cards. Go ahead, sir.
I'm John Gable. Is the mic on? From NORC. What is it?
Just get a little closer.
Oh, okay. So if we go back to the years before 2014, 2010, when we had medical underwriting, as I recall, insurance companies would go into not only the medical claims files, but also go into physicians' offices maybe, or go into hospitals, et cetera, to determine the health status of the applicant. So my question is for the panel, how much did that cost per case? It sounds expensive to me.
It was expensive. I don't know if I could give you $1 per case, but medical underwriting was very expensive. It involved, at first, just a questionnaire, right, that people would fill out, and that was easy to screen. And if someone checked yes to, I have diabetes, I have cancer, I have HIV, you were done. So that was inexpensive. But then if you had any other information, and you always, it was standard on these forms, you had to check a box that said, I grant the insurance company access to all medical records ever maintained on me anywhere. So if there was any reason to investigate you, they would pull the records. They would also subscribe to pharmacy claims databases. That was another kind of cheaper shortcut. You can tell a lot about people just by the drugs they've taken in the last year. But it could be a very involved process, and it often took, a month, 6 weeks to complete. I think With online medical claims, it's likely that if medical underwriting were to return, there would be some sort of technology advantages that might make it faster and cheaper. But it absolutely was an administrative expense that insurers don't have to incur today.
Okay, thank you. If I could add something on medical underwriting. So the size of the pool matters. So if you look at the group market today, there are several reasons it's a stable market for insurance companies. One is scale, and the second is maturity. If you sign up with your employer, you don't have to do a blood test. This is not new because it's a big enough pool that insurance companies are willing to not do medical underwriting on an individual person if it's a large group. The issue with the individual market is it's neither has scale yet, nor is it mature. So the reason medical underwriting could be something that insurers would like, especially to avoid adverse selection, is because of those factors. So the other way to think about it is if the market was to mature, or if the market was to grow to a size that is considered a good scale, you may actually not need medical underwriting at the level that we are thinking about today.
Sure. Hi, Heather Foster with the Association for Community Affiliated Plans. And I was wondering if the panel could talk a little bit about some of the potential consequences, including unintended consequences, of the idea of having these age-based tax credits that were set out in the American Health Care Act. And sort of, I've heard some talk of, well, maybe there would be a copper-type plan or more catastrophic coverage, and trying to structure benefit design around what could fit in that $2,000 to $4,000 range. And wondering if you could talk a little bit about what the impact of that would be. Would that actually be adequate coverage for people with chronic conditions, things like that?
And I'm going to take your question and add a twist, which is for people who are in that, older adult age range, what's the impact on Medicare? Does anyone know? So go ahead and answer that question. And for those of you who I understand need to pack up, et cetera, please just fill out a blue evaluation if you do need to leave. Thanks.
I mean, there are always unintended consequences of setting up a health insurance program because it's so complex. There's so many ends that needs to be tied. But to your point, the issue at hand is without linking the subsidy or the tax credit to the actual price of the marketplace, you're effectively hoping that the price matches up to the subsidy. That's it. That's the best case scenario. Unfortunately, that's not how things work. So the first consequence is obviously it becomes an issue for individuals on the higher age band. The second thing is actually adverse selection. It could, I think Cori pointed out, it's not just the young who are healthy. You can be older and healthy too. We just assume, because we have to figure out a way to create a rate band that younger people are more healthy than older, but that's not the case. So you could have people not sign up even if they're healthy, even if they're older, because they can afford it. So adverse selection is an issue as well.
Well, hi. Emma Blake, I work with Representative Byers' office over on the House side. My question is about these cost-sharing reductions. Can you talk through, if the funding is removed, what the insurer thought process looks like? Like, what is a compelling reason for insurers to stay in the marketplace markets? I've heard the possibility that the insurers might be able to sometime in the future sue the federal government to actually get those payments funded. Is that a possibility? Do you think there's a case there? Can you talk about what that looks like, 5-10 years down the road?
I think we've learned with the ACA, there's always the possibility for a lawsuit. So, I think the insurers are worried. As Dee pointed out, they provide this subsidy to the enrollees now, and then they get reimbursed later in the month, each month for people enrolled. So, insurers that are in the market now are worried, and some have even talked about, this was the Molina announcement, we'd get out now. We'd file our 90-day notice and we'd be out by September or whenever, as soon as the word comes down that we're not going to get reimbursed any longer. So, they could price for the higher, but as was pointed out, That's a pretty big buffer. So I think they're wrestling with this now. The market has grown. You know, it's not as big as we thought it was going to be, but it's still 20 million people. And I think the insurers that are participating now have, you know, a history and intended to, you know, kind of have a presence in this market. So you can exit the marketplace and not the market. The rule is if you leave the market, right, in and out of the marketplace, you can't come back for 5 years. But you can kind of step across the line and sell policies outside of the marketplace, not in the marketplace. When you're outside of the marketplace, you're not going to be liable for the CSRs because those are only delivered in the marketplace. But you're also not going to have as many people. So I think stepping out would sort of let them kind of maintain a presence without leaving, but they would really have to scale back on their revenue and on their enrollment. And then you do have insurers, not so much I think for the CSRs, but for other reasons, that including what's going on in Iowa, who are actually talking about getting out of the compliant market altogether, still keeping those grandmothered and grandfathered plans in place, which I think are very profitable. But so I think that's what insurers are wrestling with right now is, you know, how much do I want to kind of leave my option open to be in this market if it can stabilize? How much do I think, and how much am I not willing to risk this kind of immediate term uncertainty and additional losses?
Gentleman at the mic.
Hi, David Schulke with Health Quality Strategies. My son gave me permission to ask this question. So in our family, we're thinking a lot about lifetime caps right now and about the risk pools. So my son has cystic fibrosis. He's extremely healthy for a kid with cystic fibrosis, technology, and he works really hard at it. He's doing great. But he figures that in a very generous plan, with a very generous lifetime cap, he would have insurance for about 6 years, and then he'd be out there hunting around for somebody, probably a high-risk pool. And the history of these pools seems to me that the funding, they're almost always underfunded. And I'm not hearing a lot of thoughtfulness in the mechanisms for funding the high-risk pools that people, not just my son, would have to rely upon. So what do we know about the best way to figure out funding for high-risk pools? And I'm not clear at all about whether states could be automatically, you know, by default, waived out of the lifetime cap regulations that are in the ACA. So would it be automatic by default, as it says in the House bill? And what is the best arrangement for a risk pool that makes sure that people don't just, you know, get a piece of paper that's not worth anything? Thank you.
Thank you. And in answering that question, let me ask the panel, because there's a question here about invisible high-risk pools too. If you use the word invisible high-risk pool, can you also define what that is? Thanks.
Well, I'll just jump in and say hi to David. So we worked together up here a long time ago, and our sons are the same age, so I look forward to catching up. I remember when they were born. So the high-risk pools, remember I said at the beginning, you know, 20% of people account for 80% of spending in any given year. Some of us, when we're in that pool, are just in the expensive end for a little bit. Some, if you have a lifetime condition like CF, are in there for their whole lives. So when you're in that latter category, that's when you can run into a lifetime limit, and it's not that hard. So either way, if you're going to take out of the pool and put into a separate risk pool, right, the high-cost people in a government program, that's what a state high-risk pool is, then the government has to have a lot of money to pay those claims, a lot of money, not a couple of $1 billion, many billions of dollars every year if we were going to sort of create that as a way. Taking those high costs out of the pool would take a lot of pressure off insurance premiums for sure, and they would come down. But you can't do it on the cheap. In 2011, when we had 35 state high-risk pools, they were already spending combined more than $1 billion a year to cover just over 200,000 people. So these are expensive folks, and every one that you sign up, you're going to lose a lot of money on, even if you make them pay significant premiums. So the invisible high-risk pool goes the other way and says, it's reinsurance. I don't know who thought up, someone in Maine called it, because it sounded better, I guess, politically. But at any rate, it's the same thing. So instead of letting insurers move people out into a separate government program, everyone stays in the insurance pool. But you relieve pressure on the premium by saying to the insurers, instead of paying those high-cost claims with your premium revenue, send it over to the reinsurance program, and we'll pay the high-cost claim, or a part of the claim. It just depends on how it is designed. In the first year of the ACA, $10 billion for 1 year was made available for reinsurance for the individual market insurers, and that is credited with, kind of saving about 10% on the premiums. So it, right, but then in the next year the money went down, and all of the high-cost claims that got submitted to the reinsurance pool in the first year could be paid. In the next year, when the reinsurance money phased down to $6 billion, only about half of the claims could be paid. And then for the final year, it's down to, I think, $4 billion. So it takes a lot of billions every year to pay for this. And then the other way to do it is to just say to the high-cost people, you don't get to be in the pool. You just don't get insurance. That makes the premiums cheaper for the people who stay in the pool, but it leaves those other families in a very difficult position.
So, can high-risk pools work? Sure, but history shows it hasn't really worked very successfully. But what actually has worked really well is the reinsurance program. So the reinsurance program for insurance companies actually paid out more than they had expected. Of the 3 Rs that were part of ACA, reinsurance was probably the most positive. But the point you made, and Karen mentioned this, even data indicates even with the positive reinsurance program, the impact on premiums was only 10%. And I raise this point because if your average premiums are already $300, even with the best reinsurance program, let's say you just copy what was there in ACA today and keep going with it, you only have a 10% benefit. The reason I say this is because everything is trying to fix how much premiums are going up, but very little is being done towards the actual fundamental cost of care. Premiums are a representative thing, and this is simplifying it, of 2 things. One, profits. Insurance companies want to make profit. Those are low single-digit profit, that's in there. But majority of the premium that you pay represents the actual cost of claims, actual cost of healthcare. So even with trying to figure out a way to keep premiums down, it'll only go so far without actually looking at the actual cost of care.
And let me ask a follow-up, because someone actually asked this question specifically about Maine, and the question is whether invisible high-risk pools limit risk or exposure for insurers. And the questioner notes the Maine invisible high-risk pool caps the insurer's liability. And I think the question is there a difference between exposure and risk? Like, what exactly does that mean in terms of the insurer's risk exposure? Maybe you can touch on that. Thanks.
So I can't really speak, I'm not as familiar with Maine's program, but I can speak to Alaska's. So what happens in Alaska, so they have what's an invisible risk pool. What happens is somebody is in the private market, and if during the year they have a claim that indicates they have one of 33 conditions, they're put into this invisible pool. So they stay in their plan, but they're kind of in this segregated place. All the premiums for those people that they pay now go into this high-risk pool funding. And then out of that pool, all the money to pay the claims is from. And whether or not a plan, an insurer is offloading all of its risk to this high-risk pool really depends on how the risk pool is structured. Risk pools can be structured, the invisible ones where the insurer kind of retains the people in that pool. Depends on whether, say, for the uninsured, the reinsurance program, for example, the reinsurance program could cover 80% of the claims that exceed a certain level. So the insurer would still be on the hook for that, for 20% of those high-cost claims. So there's not one way to structure these programs, so it's hard to give a yes or no answer to that kind of thing.
I would just add in Iowa, where we're seeing a lot of a lot of change in what's going on. the federal reinsurance program didn't actually help that much. The federal reinsurance under the ACA had an attachment point. Instead of conditions, it was just when a person's claim exceeded, I think, $45,000, it got ceded to the risk pool, the reinsurance pool, which paid it up to a cap. So there was also a cap of $250,000. If the claim was bigger than that, it went back to the insurance company and they had to pay the rest. In Iowa, there's one person who's been covered for a couple of years under a compliant plan. Remember, most of the people aren't in compliant plans, so they're not in this pool at all, who had $18 million in claims in 1 year. So the federal government paid up to $250,000, and then it was back on Wellmark to pay this again. And they can't, this year the person was expected to have 10 million in claims. I don't know what the condition is, but it's really bad and really expensive. And to get away from that claim, if Wellmark just leaves the compliant market, then they don't have to cover this person anymore. So reinsurance, if it were designed differently, might have kept Wellmark in the market. If Wellmark had brought more people into the pool, you know, all those people out in the non-compliant plans, I promise you, are healthy people, because they could be rated up otherwise, and then they would find their way into the compliant pool. So if they could broaden their pool and have more premium dollars kind of helping to contribute to that claim, that would help as well. But it really, the design details are very important.
Let's go to Brian if you wanted to jump in, and then the young lady.
No, I would just echo that point, because every state's going to deal with it differently, and they do want that flexibility. Some want to do what Idaho, Maine, Alaska have done, which is more of identifying certain people, ceding that risk over. Some do want to do the reinsurance, but set it at different attachment points, which is where it starts, and different caps and different, you know, co-insurance. Others want to do a high-risk pool, where it's actually a government-run program. So people want to do it differently, and we think they should be able to do it depending on kind of how best it would work in their market. So.
Just want to add one more thing to this. There is private reinsurance. So companies could get private reinsurance to cover some of the costs of their high-cost people. The problem is a reinsurer is also an insurer. They don't want to take on risks that they don't have to. So maybe if somebody comes in, they have coverage and they have this multi-million-dollar claim, well, the reinsurer could reimburse the insurer for that high cost. Problem is, the next year, that reinsurer is not going to cover that person. That, you know, they don't have guaranteed issue. You know, they can pick out those people who they know are going to have high costs. So just wanted to kind of make that point that the private reinsurance market can only help so much in these kinds of situations.
Thanks. And so just to summarize, right, it sounds like we're talking about high-cost claims being part of a broader pool, and then the challenges of getting healthier people, healthier paying customers into that pool, versus a different approach whereby you know, there's some kind of a segregation, as you said, of putting someone physically in a different high-risk pool or paying their claims differently through some kind of an invisible high-risk pool. It sounds like what we're hearing. Your question, and then we'll wrap up. Thanks.
Great, thank you. Molly Smith with the American Hospital Association. So we've talked a lot about the size of the market and how important that is, as well as we've just talked about the balance of risk. And yet, if you look at the individual market, both on and off marketplace, it's actually bigger than the Medicare Advantage enrollment. And by just definition, the MA population is older. Now, maybe they're the healthier of the Medicare population, but they are presumably going to be older and probably sicker or have higher healthcare needs than the individual market. So, but that is a market that is highly sought after by commercial insurers. So what are some lessons and things that you've talked about that apply in MA that we should be thinking about bringing into the individual market? And one factor that I would like to hear some comment on is the role of the states, because one of the things we've heard up here is just how much variation there is in performance, somewhat or to a large extent based on policies that states have adopted, whether it's allowing the continuation of grandfathered or grandmothered health plans, whether it's choosing to expand Medicaid or not, whether it's allowing, you know, entities that are not traditional insurers to continue to keep back, you know, the healthy working population from within the market, all of these sorts of things that state decisions are making, and yet states have a very, very small role in oversight of the MA program and no role in setting policy. So I'm just kind of curious if you can take some lessons learned from the MA world and see if there's any application for the individual market.
It's actually a great question because a lot of the things that are in ACA are actually have been borrowed from MA, like some of the 3 Rs that are being used in ACA do exist in Medicare Advantage. But if you go back, Medicare Advantage probably when it first started had some issues of its own too, but it's a mature market now. The reason private insurers like that market is because it's a growing market. People are getting older and signing up for Medicare Advantage quite frequently. The other reason, which is why these two markets are very different, is how payment actually happens. So with Medicare Advantage, the insurance companies get paid from the federal government based on the risk of their member. So risk coding is a big issue there. So if you code your members correctly, the federal government will tell you that this is how much I'm willing to pay for it, and then you have to figure things out. So because the payment structure is very different, it doesn't work the same like the risk adjustment program works in the individual market, which is a closed program, whereas the risk adjustment, which is effectively asking the federal government to pay you for the risk you're taking, is kind of an open program. So the fundamental structure of those programs are different. Also, it's an attractive market because it's a growing market.
And so let me let Brian jump in, and then we'll wrap up.
Yeah, and I would also say under MA, they can very much choose where they want to operate within a state, and if they don't operate statewide, there's something called Medicare, traditional. So they can find areas that are more profitable to them, which we're trying to keep the private insurance market from doing that and have them go statewide in all areas. And as far as state decisions, yes, state decisions will always impact not just ones you mentioned, but just policies with regard to how providers are done and how practices are done and how contracting is done, and all of those will all have impacts, and that's why sometimes it takes that balance at the state level.
Officially out of time. I'm sorry. We could probably talk about this for days and days. And the Alliance, we're here. We will be back. Fill out your blue evaluation forms. Tell us what you want to hear about. And please join me in thanking our panelists.